Hello, welcome back. I have another video here for you. This one I'm going to talk about why I go with short put spreads, why this is my strategy going forward. First of all, a disclaimer, I'm not going to read it for you, you can read it for yourself. Okay, why short put spreads? I'm going to start here with car insurance company. Car insurance. I don't know a lot about car insurance, but here's what I do know. I'm paying TD Bank $100 a month to insure my car. It's about $1,200 a year or $12,000 over 10 years. And the idea is if I cause a car crash driving properly, I'm going to be covered up to $1 million. So if I cause an accident, which is $1 million worth, then TD pays for all the damage past a certain point. So I think there's like a deductible or something I need to pay. But I'm paying $100 a month. And if I cause a crash, I pay $1 million. Now, that doesn't, I know something's off there because this $12,000 a year, how come I'm insured for $1 million? And I think the answer has to do with TD's done, they're $1 billion company, obviously, $1 billion bank, which offers insurance as well. They've done some research and they've determined that if a certain number of people pay insurance, only a few of those certain number of people will actually cause $1 million worth of damage. And they've done a lot of work to figure out how much to charge each person for car insurance. Now, there are things that can be insured, right? Cars can be insured, houses can be insured. Believe it or not, stocks can be insured too. There are companies out there that have not like one or two or 100 shares of SPY. They have 1 million shares of SPY. And it's a good idea, I guess, to insure the stocks just in case there is a market crash. If SPY were to fall 100, say $100, for me trading, if I had 100 shares of SPY, yeah, I would lose about 25% of my portfolio, right? So that'd be bad. But if I had $1 billion worth of shares of SPY, I'd lose $250 million. So kind of makes sense to get the insurance if it's available. But there's a little key difference between the car insurance world and the stock insurance world. With car insurance, not everyone, I don't think anyone can just set up a car insurance outfit. I think that would be hard. I think there's like some regulatory licensing requirements, probably some capital requirements as well. It's not that easy. With stock insurance, though, it's a much different story. Anyone can set up, as long as they have enough money, can set up a stock insurance company and start selling insurance. I'm not kidding you. And believe it or not, you can do it with $3,000. You can do that on Interactive Brokers with $3,000. I am not kidding you. You can sell stock insurance, which sounds crazy, it's scary, and intimidating. I showed you in a previous video how you can take a max loss of $435. That's actually what you would lose in a worst case scenario, which you're not going to ever have as long as you're closing your contracts within 14 days. So, for example, if I don't know how well this is going to work because the market's closed, it's just past 2 o'clock here. I might need to switch to SPX here. Let me see if I can do something. Okay, SPY. What is SPY at right now? SPY is $457. If SPY were to fall to $440, you could buy stock insurance. Stock insurance would cost, because insurance contracts most of the time is one contract is for 100 shares, it would be $3.44 per share, or $347 total. Sorry, I'm just moving my water so I can actually see my screen here. You could buy stock insurance for $347, and what that would do is that would insure 100 shares worth of SPY at $440. Oh my gosh, I'm sorry, I'm trying to drag something over here. I'm trying to drag the pretty picture over. And the demo mode is not the most user friendly here. This is what I was trying to pull. It would cost $372, but you'd be insuring for about $440,000 worth of stock. I think that's cheap. Like, what's 372 divided by 440,000? I'll do the math here for you. 372 divided by It's only 0.08%, and that insures you know how you're paying your insurance every month? Your car is only insured for a month. You're insured for 38 days. So 0.08% of the price. It's not too bad, right? It's just like if I'm insured, if I pay $100 a month, I'm insured in my car for $1 million worth of crashes, right? I know I'm putting this crudely, but who's really winning on this transaction? I'm paying TD $100 a month. Who's really winning? I know I'm not causing $1 million worth of car crashes a month, but TD, their insurance division, I'm pretty sure is doing pretty well. Now, why is that? I think the answer is going to be coming up in a second here, but yeah, it's something to keep in mind. It's actually the seller of the insurance that usually makes the money on this transaction. So, I'm just reading through what I have here. Remember that. So you do have that ability. You can actually, and I actually click sell here, so you can click buy. Let me just clear this out. I'll make this a little more clear. Okay, I'll assume that I have 440. I have $44,000 worth of SPY. I'll buy the insurance, and the insurance is going to cost me $365, and it's going to populate on the wrong window, and I'm going to drag that back here. I'm purchasing it for $375. Yeah, I got it right. Yeah, I'm purchasing it for $375. But if I do this every month, and it's going to cost me $375 a month, if I never needed the insurance contract, I do lose money, right? I'm going to lose the $375 a month, but it's only costing me 0.8% as I went through. So, not looking too bad, right? And as I showed you before here, you can actually be the seller as well. You can play TD Bank and click the sell side just as easily as the buy side. You can sell the insurance. All you need is 437,000. That's actually not the true number. I'm not going to go through that here. But you don't actually need 437,000. You only need $7,800 to sell this insurance. I kid you not. But that's not here. I'm not going to go through that discussion here. Okay, so you can actually sell the insurance. And it's not just you're selling insurance and you're not just playing the game, you're actually providing value because someone needs to insure their contracts. Somebody wants to buy the insurance. You're agreeing to take the insurance. However, you're at risk of losing $44,000 if SPY crashes, which if SPY really crashed to zero, I think there's a bigger problem. I don't think money is going to be worth as much as it was before. But remember, also, we're not putting $7,000 or $44,000 at risk. We're only putting $500 worth of risk. But if you're executing my strategy here, you're selling this contract at $440, but you're buying insurance yourself at $435, right? So it says 63 cents here. You're only risking $500. So if SPY falls to 438, 437, 436, if you're insuring 100 shares worth of this, yes, you're going to lose $100 per dollar. This thing falls under 440. But if you're buying insurance at 435, then someone else is selling you the insurance and you're covered. Hopefully that made sense. If you need me to go through that again, well, you can try rewatching this part of the video or ask me in person. So the most you can lose, because you're insured, if you're buying this contract here, you're insured past 435. The max you can lose is $500. However, you are making a profit because you're buying this insurance contract for about $2.99 or whatever. I'll just call this $3. You are taking in a premium of $3.60. So you're actually netting $60. You get paid to sell the insurance. It comes into your account right away. You have to agree to insure the other person, whoever's paying it. You have to put up money. You have to put up collateral. But you do take in the money. And that's the beautiful thing about selling put spreads. Now, what do I have here? Remember the research that TD does? I don't know what it's called. It's some actuarial study. But the trading world, I have a much better grasp on. These deltas here that I went through earlier, this is akin to the research. This is pretty close to the research that the companies that do make these markets, there are trillions of dollars worth of liquidity providers. I'm not going to get through that here. That do a lot of research. They put together this delta number. This delta number is based on something called the Black-Scholes model. That's the actuarial model in the trading world. You see this delta here. Right now it's at 24. That means that between now and 38 days to go before this particular option expires, there is a 24% chance that this option will be needed. Hopefully that made sense. So that means there's a 76% chance that this option will not be needed. Okay, so that research does exist. I like to live there at the 25 delta number. So now lastly, why this strategy? Okay, as time passes, as long as the insurance contract is not needed, remember there's a 75% chance that this contract will not be needed. There's a higher chance that, so naturally the contract will be worth less. So here I'm at 38 days, 440 strike is costing 365. I'm going to look at the 440 strike, but I'm going to look something closer, like November 5th. What would the 440 strike go for? 70 cents. You notice how much money it lost? 70 cents. It was at 360, I think it was. Now it's at 70. What is 360 minus 70? I'm an engineer, I should know this. Minus 70. It lost $290. So if you actually sold this insurance contract, which you can by hitting this side, sell leg, you would have made $70 if you sold that 440 contract. Well, not quite. In theory, you would have made $70. It's not exactly how it works, but it's close enough. As time passes, there's less and less of a chance that the contract will actually be needed. So time decay actually, if you're on the seller, time decay actually works in your favor. If SPY's price stays the same, you're making money off time decay because the chance that your insurance contract that you've sold is the chance is going to be less. This is good for the holder, or this is not good for the holder. So if you're buying the insurance contract is losing value, but you feel safe and secure. Your shares are insured. As a seller, though, you're banking on the fact that people are more scared that stuff is going to happen than the chance that something's actually going to happen. And you, as a seller, are covered as long as you're doing this put spread method. I'm going to go through this a little bit. So I've done a lot of courses on how to invest in real estate as well. Buying an income property, there are 4 ways to win. There are 4 ways to make money on an income property. The first way is you make money on cash flow. So you have a tenant in your property and they're paying you money every month. You make money that way. The property appreciates in value. A property, real estate, just like here I am in SPY, real estate eventually, most of the time, will appreciate in value. You can also do, the tenant is paying off your mortgage. That's a third way. So you're not paying the mortgage off that you took on, your tenant is. So principal recapture, I think that's what it's called. And lastly, you can do improvements to your property so it has a higher resale value, so you can flip it or sell it for a higher price. There are 4 ways. Stock market, as far as most people who are not watching this video are concerned, they think there's only one way to make money. You buy low, sell high. You look for whatever stocks or whatever is trending on social media. Ooh, this one has abnormal volume. Ooh, this one has some news that's going to be released soon that not everyone knows about. It's going to go up in value and then hit the sell button. Here's the thing. With my strategy, there's 2 ways. One, positive drift. I think that SPY in the long term, the S&P 500, is going to go up over time. I don't know what companies are going to be at the top 20. I actually looked this up. But in 2000, the top 10 companies in SPY, General Electric, Microsoft, ExxonMobil, Pfizer, Pfizer, it's it's because of the pandemic, Walmart, AIG, Cisco. Today, it's not that. Today, it's the Facebook, Google, Amazon, Tesla, and Warren Buffett's company, the Berkshire Hathaway, JP Morgan Chase. Those are the top. So it changes. But Apple, Microsoft, I'm actually surprised Microsoft's still pretty strong. I thought Microsoft would have fallen a little bit. But Amazon, Apple, Tesla, those companies are stronger than the GE Microsoft, well, not Microsoft, but Exxon City. You know what I'm. Hopefully, you understand what I'm trying to say here. The people will get there's more information available to the human population. I think not innocent individually speaking, but in general, humans are getting smarter. They have access to more information. Yes, we're getting addicted to technology. My kids are totally addicted to technology. But I think innovation today, it's easier to access information today. So I think the top 10 companies of today will not be as strong as the top 10 companies 20, 30 years from now. Inflation, money printing, the value of a dollar is going to go down. So thus stuff is going to just naturally cost more. So a share of SPY is naturally just going to cost more. So I think the market's going to go up. But now that I've explained a little bit about time decay, you'll understand that even if SPY, S&P 500 stays, you still make money selling the insurance company contracts. The only way you lose money is if it keeps going down over time. But remember, you're selling the insurance contracts, so you're still taking in money. You will be losing more if you just hold the S&P 500 contract. You make more money taking in premium. You get paid to hold insurance contracts. That's the key part here. And that's why I'm doing what I'm doing. Hopefully this made sense. If I completely lost you again, if you're watching this video, you probably know me personally. Let me know where you're stuck, where you need help. I will do the best I can to help you. Otherwise, happy trading, enjoy. Watch that first video, follow that first video, follow all the steps strictly, no deviations. If you're not making money, you'll be making money for the first time. If not, you'll see. You'll see. It works. That's enough for now. Talk to you later. Bye.